Hello, and welcome to Donatian Investment. This analysis is for Netflix on Nasdaq as of 20th of July 2026 with a share price of $67.60. The full report is on donatian.ca. Netflix is an elite streaming business, and after a roughly 13% post-earnings drop, it is finally cheap on clean earnings, which is why the medium and long calls both move up to buy. But the short-term call stays hold. The tape is a strong downtrend. All 5 timeframes are falling, and there is no confirmed entry yet. Accumulate on weakness, or buy on a trend reclaim, rather than chasing it into the downtrend. The quality here is genuine. Netflix runs the biggest content budget in the industry across roughly 300 million members, which buys it the best per-title economics of any streamer, operating margins around 33%, and top decile returns on capital. Quality scores 79. What changed is the price. The post-earnings drop took the shares down about half from their high, and on clean operating earnings the stock now trades near its warranted multiple, in the second decile of its own 5-year range, and well below the analyst consensus. For a business of this quality, that is cheap. So why not buy it today? Because the tape is a falling knife. All 5 timeframes, monthly, weekly, daily, hourly, and 15-minute, are in a downtrend. The stock has broken support, and relative strength is dreadful, down about 47% against the market over a year. It is deeply oversold, which can mark a near-term low, but momentum has not turned, and there is no confirmation. The base signal is a buy on value, but our rule caps a fundamental only entry into a downtrend to hold, buy on a reclaim of 74, or on a confirmed higher low off 65. The driver is global streaming demand and how fast Netflix can monetize it, and right now, that is neutral rather than a tailwind. The next quarter guide of about 12% growth is the slowest in 3 years, so the easy password sharing and ad launch tailwinds are maturing. A neutral driver does not amplify, which is why the medium and long calls are a plain buy, not a strong buy. Competition is the other pressure. Disney with live sport, a consolidated Paramount and Warner rival, and YouTube taking share of total watch time. Netflix is still the leader by engagement, but the walls are being tested. The risks are loud, and they are the reason the stock is cheap. The bear case sees the shares fall to about $52, roughly a quarter below today. That takes growth decelerating below 10%, while the competition, Disney and its live sport, the combined Paramount and Warner assets, and YouTube's lead in watch time, pressures engagement, and the content cost arms race squeezes margins. The multiple would compress on flat earnings, and the stock would test its monthly support. On top of that, the tape is already in a strong downtrend, so a value buyer here can be early and painfully so. This is a real, present risk, not a distant tail. Now weigh the risk against the reward. The bull case is roughly 55% above today, the base case, the most likely, about 26%, and the bear case a fall of about 23%. So you are risking about 23 to make 55. So I'll call on Netflix on Nasdaq, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donatian Investment at donatian.ca. The link to the full report is in the notes below. Have a great day.